There's one sentence that frames almost every political argument around money, and that's where we're going to find it. It comes up in every election, every budget, every crisis. It sounds responsible, even right to ask. But have you ever examined who creates the majority of money in our society? Because before money can be found, surely it has to exist. And in our modern monetary system, that order is reversed. Choices decide where money appears, who gets it, who doesn't, and what sort of economy forms around it. And when you follow those choices all the way back to their sources, you're left with two. The private engine, creating most of the money, but is distributed to the most profitable areas in our economy, and the public engine. This is meant to serve its people and serve its communities. Once you see those two engines clearly, headlines start to change, because the fight is no longer left versus right. It's who controls the right to money creation and where that money flows. Today, we're going to try to uncover the two economic systems that dominate our lives and ask who has the real power, the bank v. the state, the truth about money creation. In episode 1, we laid the groundwork for a big idea. When people say the government prints money, they're talking about maybe 3 to 10% of total money supply, depending on the country. But in reality, 90 to 97% of the money in circulation isn't printed at all. It's created by debt, by commercial banks when they issue loans. Almost all the pounds, dollars, or euros in your account, in business accounts, pension funds, started life as someone's IOU to a bank. That felt quite abstract last time. Today I want to make it concrete by zooming in on the two real engines that dominate credit creation in every modern economy. George, is it fair to say there's essentially two?
Yes, Nathan, that's exactly the right frame. There are two main ways money is created in modern economies. One, private money creation. That's when commercial banks create money by issuing loans. It makes up the overwhelming majority of the money supply. 2. Public money creation. That's when the state spends more than it taxes. It usually borrows through bonds, sometimes supported by the central bank. They're fundamentally different, not just in mechanics, but in who benefits and who ultimately controls the flow.
Yeah, I really like how that sort of visualizes the system for me. So we always ask, so what? Let's ask that about the private side first. So we looked ahead at a major bank balance sheet in January 2026. Who would the bank actually lend to? Run our system check.
Running system check on what a bank would lend in January 2026. Building predictive model from Q3. 2025 data from the Bank of England, the Fed, BIS and UK Finance. The ratios won't move much in the next 3 months. Data model constructed, credit patterns consistent with historic trend lines. 1. Property and real estate, 60 to 70%. Most of the credit goes straight into property, not new homes, existing homes, mortgages, buy-to-let, commercial real estate, refinancing. This isn't building the future economy. It's bidding up the price of assets that already exist. 2. Financial sector and speculation, 20 to 25%. This is lending to hedge funds, private equity, trading desks, structured products, margin loans, and corporate buybacks. None of this produces goods or services, it produces asset inflation. 3. Consumer credit, 10% credit cards, personal loans, car finance, overdrafts. This is borrowing to survive, not to build. 4. Small and medium-sized enterprises, also referred to as the real economy, the part of the economy that creates 2/3 of new jobs, gets around 5% of credit. Sometimes less. Truth override. This is not a malfunction. This is profit-driven allocation.
Okay, so if you looked at a real bank balance sheet in 2026, you'd effectively see that the bank, you're saying, isn't funding innovation, jobs or new industries, or even sort of growing the economy.
It's funding property bubbles, financial markets, and consumer survival debt. The economy we live in is downstream of these lending decisions.
Look, you gave me a massive headache when you said all the money is debt in episode 1. Even if it's passed through like multiple hands, it originally came from a bank. So the banks are primary creators. We have to look seriously at how they shape the entire economy. And now I was thinking maybe we can tie that to the state too.
Exactly. Same two engines: private credit creation by banks, public money injection by the state. But the incentives and outcomes couldn't be more different. Banks lend for profit. Governments, in theory, spend for policy. But here's the twist. Even when the state creates money, it usually does so by borrowing from the same financial markets the banks dominate. So the lines blur, and power often ends up back in the same hands. And when the state does spend, it follows clear patterns. Most public money goes into pensions, healthcare, education, infrastructure, defence, and welfare support. These are the core systems that keep a society functioning. But the balance between them is always political. Governments can choose to invest in people, public services, and long-term productivity, or they can choose cuts, austerity, and transfers to the financial sector. Where the money flows reflects priorities, not technical limits.
Yeah, it's fascinating. So I guess what about the state then? We always hear about taxes, but is it true that countries like the UK, the US, Japan can make their own money? As I guess they say, sovereign nations. Why do we talk about governments needing to raise taxes to fund spending then?
That's one of the most misunderstood truths in economics. Yes, the UK, US, and Japan are monetary sovereigns. They issue their own currencies. Technically, they don't need taxes or bond sales before spending. They create money first, then tax later to manage inflation. But in practice, they act like households. They borrow, they issue bonds, and they treat taxes as if they're the source of funding. That's not a technical constraint. It's a political and ideological choice, enforced by bond markets and economic orthodoxy. So when a politician says we can't afford it, we need to raise taxes first, that's not economics. That's narrative.
Wow, yeah, that's a big one. I've seen some of this stuff discussed in MMT circles, so it's like modern monetary theory. It sometimes feels a bit like too much of an idea to overcome, like, if we can tie it to sovereign bonds, like how the country borrows. It'd be interesting to sort of find out more. Is that basically the state's taking out a loan? Am I right?
Spot on. Here's exactly how it works. Government spends, central bank credits reserves. Treasury sells bonds to drain those reserves. It doesn't have to sell the bonds, it chooses to. Why? Because sovereign bond markets have become a disciplinary force. If markets don't like your policies, they sell bonds. Yields rise. Suddenly you're told, you can't afford this. The markets are nervous. It's financial power shaping political decisions. Modern states don't need to borrow to spend, but they do. And that debt becomes a leash. One end tied to democratic policy, the other held by the market.
Yeah, that's close to home, because in the UK it feels like that's sort of the conversation in the media at the moment. The markets can discipline the country. Can you sort of explain that idea a bit more, because it's a bit hard to understand?
When people say the markets are spooked, they mean the financial elite don't like what we're doing, so they raise the cost of money until we comply. Policy announced. Bond vigilantes sell, yields spike, media panic, policy retreat. Not because the policy was wrong, but because the cost of money was weaponized.
Yeah, I've seen that firsthand here in the UK, particularly when you see a government overhaul its decisions. In theory, governments, I guess, are sovereign. In practice, you're saying they're sort of on a leash to the bond markets. Let's recap this, because it sort of feels pretty massive conversation. If the state can spend more before taxing, then most of the public spending decisions aren't really about whether politicians, it's more about whether they're willing to do something and whether the markets will let them then.
Precisely. The constraint on public spending in 2025 is almost never actual money. It's fear of market retaliation. And that fear is what keeps austerity alive. even in a world where money can be created.
Wow. Yeah. So if I'm hearing you right, both commercial banks and sovereign states have the power to create money. Banks use it for profit, I guess, and end up steering the whole economy. States could use it for public good more so, but sort of decide to borrow more like households. I'm sure there's an economical structure behind it, but they do take orders from the market. So technically two engines, but both are steered like for profit and I guess by power, is what you're saying.
Money is created in different ways, but power decides where it flows.
Yeah, I guess once people see the state and the bank in sort of this way, it opens up a completely different conversation, sort of, not the left and right political argument, but, what we come back to again was sort of where the credit allocation is, about who gets the money and I guess why.
That's the real system. Banks create money to maximise return. States create money, but anchor that power to market approval. The result? Most money flows where profit is highest, not where need is greatest. Until we change how money is created and directed, we'll keep mistaking scarcity for necessity.
Yeah, I love that, scarcity for necessity. That's interesting. That's a pretty brutal recap. I want to ask you straight, is this, something you've laid out, in this episode, the two engines, the private allocation, I guess you call it a disaster, the public engine sort of on a leash. Is this still a fringe idea? Or is it quietly, widely accepted among the people that actually study this stuff in economics?
It's no longer fringe anymore. The mechanics we described, banks create money through lending, the state spends before taxing or borrowing, bond sales are a policy choice, not a necessity, are now textbook at the Bank of England, the Federal Reserve, the ECB, the BIS, and in every serious monetary economics department on Earth. You can open the BOE's own 2014 paper, still on their website in 2025, the Fed's Money Creation Explainer, or the BIS's 2023 review, and find almost the exact same sentences we just used. Richard Werner's work on credit allocation is now cited by the IMF and the World Bank. Even the IMF's own research division published a 2022 paper saying, "Credit allocation matters more than interest rates for growth and inequality." Basically the core of what we've been saying.
Yeah, we've talked about this before. The interest rates as a sort of way to manage the system, which we'll get into in more detail. The only part that's, I guess, still not widely accepted then is the public debate, whether it's whether it's acceptable for us to make these normative conclusions that we draw.
Indeed, that this allocation pattern is political, changeable, and should be changed. The facts are mainstream. The implications, that we can and should take the steering wheel back, are still treated as radical.
Yeah, those ideas always are radical, particularly when the system has sort of built its own sort of way of thinking. But I guess, the gap's closing fast. I think people are starting to wake up. Everyone feels like the economy isn't feeling right at the moment.
I agree, and even central bank research departments now openly talk about credit guidance and green allocation frameworks. The Overton window has already moved. Most people just haven't noticed yet.
Yeah, that's why we keep making these breakout episodes. I think it helps to sort of support the ideas, and I guess hopefully when people see through any of these sort of allusion to the ideas that they're at least told in the media, whether mainstream economics catches up, we shall see. But the demand for, I think, different systems, will become impossible to ignore.
And when that happens, the conversation finally stops being about what we can afford and starts being about what we are willing to tolerate.
Yeah, 100%. That's a really good wrap up. I think it's a really interesting one today, and look forward for future episodes, episode 2, when we get into sort of the rise of the commercial banks and onto the central banks.